I want to thank Jeremy for being here, and I'm going to turn it over to you, Jeremy.
Thanks, Jeannie. I appreciate it. So as Jeannie said, we're going to be talking about cap rates today on this webinar, and the webinar should last for about 30 minutes. And the idea here is to just get a general sense of what the cap rate is, how people use it, and so on and so forth. So we're going to talk a little bit about what we're going to see here in a second. So just zooming out, we're looking at the kind of real estate world from the top of Boston. And as you look out, you can see there are a lot of different types of buildings. Every single building in this picture, be it an apartment building, retail property, office property, and off in the distance you'll see some industrial properties. They all have their own sort of valuation, and those valuations are driven by one key formula, and that is the cap rate itself. So what we're going to talk about today in the webinar, primarily it's for you if you've ever asked and wanted to be focused on any of these topics. So you're interested in commercial real estate in general, maybe you have a background in residential properties, and you're curious about commercial real estate and what is, what the world's like on the other side. You're looking to memorize the terminology and learn about cap rates in general. You might be trying to figure out, hey, where's the best place to invest? How much should I be paying for property? What's the cap rate like in my market, or by asset type, by retail, office, industrial, hotel, land? What should I be paying for property? And also talking about your exit valuation. How do you figure out what a property is going to be worth after you've bought it and it's time to go sell the property, and you put a cap rate on that, figure out where you're going to be able to go out in the market. So before we dive in to the real nitty-gritty on cap rates, there's a lot of confusion about what cap rate is. And Gene, I'm sure you've seen this in your classes and teaching, where people come in, and students come in, they say, this cap rate thing drives me crazy. What is it really? So what we've done is just sort of broken it down into plain English. Cap rate is the percentage of the purchase price you receive back in the first 12 months of net operating income. So what does that really mean? Well, what it means is you're going to buy a piece of property, and when you put down a lump sum of cash to purchase it, and let's just say you're doing it without any financing, you want to know, after you pay your operating expenses, how much of that money is coming back to you in the first 12 months of ownership. That's what a cap rate is, the capitalization rate. That's all it is. It's a percentage. It's a percentage statement of what you're getting back. So before I go in a little bit further, I'll just sort of brief you on how I came to where I am, and Jeannie did a great job at the introduction. I appreciate that. Before I got into commercial real estate, I actually was supposed to be a college professor. I was going to grad school at the University of Virginia. I was working on my PhD in African history, and being a teacher at heart, I really wanted to be a professor and spend 80 to 90% of my time teaching. The other 10 to 20% I wanted to invest in real estate. And what happened was I got to a point in my studies where I decided that I didn't want to be a full-time professor anymore, so I left school and I flipped my my approach. And I instead focused 80 to 90% on real estate investing and the other 10 to 20% on teaching, which is why I do things like this and teach for the CCIM Institute. So as a result of that, what I've been able to do over time was develop an expertise in this space. As I said, I was going to be a history professor. The last math class I had was my freshman year of college, and I can tell you that I hadn't had to do any math in a long time. So when I first started investing and brokering and advising in commercial real estate, I didn't know what I was doing. And I was running into this cap rate question, and I was trying to figure out how did the finance side of the business work. So I went out, I took some CCIM courses and worked through the material, and ultimately figured out how this all how this all worked, and then was asked by the Institute to apply to be an instructor. So I went back, and in 2008, they brought me on faculty, and since then I've been very fortunate. I've taught with Gene, and also had the opportunity to teach folks from all of these these world-class organizations, U.S. government, about commercial real estate. So it's been a lot of fun, met a lot of great people, and I really enjoy it. So going into sort of the cap rate universe, we had that picture of Boston and looking out over the landscape. We have this idea of, well, how do we figure out what's going on in the market, and how do we value these properties? So I've thrown up a picture here. This is a chart that's got data from the Federal Reserve and NCREIF and Cornerstone Research showing, it shows a 10-year Treasury, it shows the corporate bond market, and the REIT cap rate market. So these three lines. The red line, this is the REIT cap rate market, and the data here is taking us up into just early 2009, where you can see the market correction coming into play. The green line here is actually the green line is your cap rate line. The red line is your corporate bond rate. So your corporate debt's at a higher rate than your cap rates. And your blue line is your 10-year Treasury, and you can see it was diving going into the recession. The spreads here give you an indication for what the capital markets are up to and how they're perceiving activity out there. And what this does is it gives you a sense of how investors, when they go out to purchase or invest their money, what they believe they should be receiving back as a percentage in that first 12-month period. So down here in the bond market, the 10-year Treasury market, this market is saying, look, if I invest my money here, I see it as a very low-risk investment. I'll get my money back, so I'm willing to accept a very low rate on that. So if here it's about 2.5%. If I were to go out and buy just put $1 million into an investment, I'm willing to take 2.5% of that back in the first 12 months. If you go up to the cap rate market, I put $1 million into a property, and you can see the cap rate going up. Investors are saying, I want to receive more of my money back in the first 12 months. I see more risk in the market. And then the corporate bond market here, the red line, pricing risk in as well. Drilling into the cap rate itself in a transaction to appraisal perspective, transactionally, you can see the red line here. This is historic, going out all the way up to 2011, halfway into 2011, and as far back as 1991. And what you'll see here is you see the volatility in cap rates over time. And if you follow these, what you'll find is that they tend to mirror what's going on in the economy. They lag a little bit. Here at 2000, 2001, we had a spike. That was the dot-com boom, if you remember, and bust. You can see out here as the market became more and more overheated, investors continued to pay lower and lower cap rates. The blue line being how the appraisers are viewing the market, and the red line being how investors are viewing the market. They seem to be trailing together on a pretty level basis until you get to this inflection point out in 2008, where investors responded more quickly, and they said, look, cap rates have got to go up. The market's become very risky. I'm nervous. And the appraisers, it took them a little while to react to that. I don't know if any of you were doing transactions in that 2008 and 9 time frame. It was sometimes difficult to work deals with appraisers because the appraisers weren't in alignment with where investors were, and we're trying to all figure out where the valuations were headed. But as the market started to recover, the cap rate started to come back down again. So this gives you a sense of how the cap rates have risen and fallen over time. And if you were to look at this picture over a 20-year period, it looks like our average, or probably our median, was probably somewhere around maybe 7.5%. in this range if you were to draw a median line across this chart. So I've got a quick question for all of you. Let's do a quick poll, and why don't you tell me, going forward in the next 12 months, where do you see cap rates going? Do you think they're going to go up, go down, remain flat, or just not? Just tell us what you think. This is interesting. I'm watching the stats come in here live on the other end. I'm going to publish this in a second.
Yeah. And
Just so
Mike, Mike might be listening on the phone, and he says they're going to be mostly flat with a slight increase. So you can add that to the
okay.
data.
And Mike's typing some more in here.
Mm-hmm.
Mike, you might be swaying our survey results. Okay, so great. We got 81% of the group here that's responded. I'm going to share the results now so you can see them. And what you'll find is that 33% of the group actually think that over the next 12 months, cap rates are going to increase. 19% think that we'll see a decrease. And in the same amount, 19% said they'll remain flat. And then 19% said, I don't know. Jeannie, what do you think? What do you think in the next 12 months based on what we're looking at in our economic conditions? What do you think? What do you think is going to happen?
I think it depends on the sector, but I believe that if we looked at apartments, for example, I think that they're going to increase, meaning that those they'll decrease with the prices going up. We've got a lot of uncertainty with the new tax law. They actually have on the table that exchanges might be considered for elimination, and people who've been holding off selling may decide that it's better to get out now if their long-term goal was to divest. So I'm seeing a decrease in cap rates, meaning a little bit of an increase in prices. What do you think?
So I think that, and I think we're actually going to see a gradual increase in cap rates over the next 12 months. If you look at the 10-year Treasury over the last 6 months, the 10-year Treasury has gone from 1.6% up to, it's gone up to, I'm going to zoom in here. I'm actually going to jump down to that Treasury chart that we had. It's gone from 1.6% up to 2.8%. So we've seen an increase in the yield rate of the 10-year Treasury, which is what this number down here is. Now, when that happens, you start to see this upward pressure in the market. You're going to find that your cap rates are going to also increase, because what happens is if I'm an investor and I can earn 2.8% on my money going into a bond for 10 years, then I need to have a spread to pay for the risk between the bonds and the cap rates in the market today. So the more that those bonds go up in price, the more it's going to cost to borrow money, and the more it costs to borrow money, the higher the cap rate I'm going to have to pay in order to get the return I want. So I think we're actually going to see some upward pressure. It's not something that I would say you should run out and tell everyone the sky's falling. But this is going to be a gradual adjustment. What the Federal Reserve has been trying to do has been to kind of wean the economy off of the morphine drip of bond buying, and they're calling, you hear referred to as quantitative easing. They're now going to start to taper, so they call it tapering. And when they're tapering, what they're doing is they're slowing the rate at which they'll buy the bonds, which means that they see that the economy is becoming a little stronger and it can walk on its own, and they want to try to nudge the economy forward. So as that happens, you're going to see interest rates go up a little bit, and as interest rates go up a little bit, I think you're going to see some upward pressure on cap rates. So here's what we're going to do. We're going to really get into the cap rate itself. So we'll talk about net operating income. The reason we're going to talk about that is because if you don't understand net operating income, you can't understand the cap rate. So I'm going to take you through the definition of net operating income, show you how it's calculated. Then we're going to do the cap rate definition itself, what the formula is, how to calculate the cap rate, and then we're going to talk about the exit cap rate. So you've got two of them. You have the one that you're buying with, and you have the one that you're selling with. And then lastly, we're going to wrap up with talking about cash on cash return and what I call the target cap rate. So let's take a look at this net operating income concept. A high level, net operating income is a very, very, very important number to understand. And it's important because what it tells us is the amount of cash that you're left with after you've collected all your rent, subtracted for vacancy and credit loss, added back in any income that you receive. So for example, maybe you own an apartment building and you have a laundry room and you collect income from that laundry room. You would add that back in and equal out to a gross operating income. So this is the amount of money you have to operate the investment. Once you have that amount of capital, you then have to go and pay for your operating expenses. Your operating expenses are made up of utilities, management, snow plowing, landscaping, insurance, accounting, legal services, all those things that you need to maintain and sustain the investment and hopefully grow it. And after you've operated it, you have what's called the net operating income. It's commonly referred to as NOI. Now, when you're out in the marketplace, it's sloppy out there. People don't all calculate NOI the same way. I don't know about you, Gene, but I'll see a lot of different calculations for NOI. So, for example, you might look at an investment opportunity, and let's say it's a large medical office building, and the building is 85% occupied, but the net operating income that you're seeing is assuming that there's zero vacancy and that 15% is leased. So it's really a pro forma. It's a pro forma net operating income. It's not an actual number. So when you see that and you go to calculate a valuation based on a pro forma net operating income, you could end up with a number that may be skewed in its valuation against what the actual numbers are. So the cap rate, the sort of textbook definition is it's an investment measure. So it's a measure that we use to determine value. It's defined as the ratio relationship. So you'll always see it as a percentage. The cap rate is always a percentage number. It's the ratio relationship between the first year's net operating income. Remember, that's that first 12 months of net income you have after you've paid to operate the property, and the purchase price of your investment. So depicted in another way, in plain English, it's the percentage of that purchase price you get back in the first 12 months. Okay? So if you pay $1 million and you get $100,000 back in cash flow, that's that net income. Over the next 12 months, the cap rate would be 10%. You're receiving 10% of that $1 million back over the next 12 months. So that's all the cap rate is telling you. So visually, this is what it looks like. You have this $1 million outlay. This is the total purchase price here. 900,000 of it is still out, okay? And you've gotten 100,000 back in the first year. So that's the 10% cap rate. Now, as you get out in the marketplace, you might wonder, well, geez, what cap rate should I be using? How do I calculate it? What are people using today to buy and sell? What are the assumptions? We're going to talk about that in just a second. So when you calculate these, you've got a couple different ways to run the formula. You can use the income divided by cap rate to get to your value. So in this case, we're taking our $1 million property, we're taking $100,000 in net income, dividing it by our cap rate of 10% to come up with our total value of $1 million. If we already know the asking price and we know the cap rate we're looking for, which here is 10%, then we can determine the net operating income, which would be $100,000 a year. And then shown another way, we could take the net operating income and divide it by $1 million to come up with that 10% cap rate. So where do you go to find out what cap rates are in the market? Well, here's a guide that you can go to. And the caveat is that I wouldn't suggest that you treat this as the be-all, end-all of what cap rates should be, but it's a really, really good benchmark and resource for figuring out approximately what's going on in your market. You can go to IRR.com, and I'll actually take you out there really quickly and show you the website. So IRR.com it's Integra Realty Resources. They have a really great website, and what they do is they are appraisers, they're national appraisers. They take all of the data that their appraisers put together, and they compile it, and then they publish a guide called the Viewpoint Guide. So over on the left-hand side of your screen, you're going to see this little thumbnail image, and it's a free guide that you can download. So you might either now or after the webinar, you can go to this website and hit the Download Now button and download that guide. Inside that guide, you're going to see all kinds of charts and graphs and great information showing you by property type what investors have been paying, what they expect to be selling in their markets over the hold period that they have. They've also got some information there based on internal rates of return and a lot of other information. So it's a really, really good resource. You can grab it. It's a free PDF download. Go out and take a look at it. You can thumb through it, and it'll give you a sense of what appraisers see going on. And if you remember, those appraisers are represented by that blue line on that chart. So some of the pros and cons with cap rates, it's a really fast calculation. It's easy to use. It accounts for gross rent, vacancy, and operating expenses, so it gives you a pretty good perspective of what's going on with a property opportunity. But some of the cons, it gives you a one-year snapshot, so that the cap rate's not telling you what's happening in years 2, 3, 4, 5, so on and so forth as you study that investment. You're only getting that first-year picture. So don't be fooled. The worst case is you have, let's say you had a 100% occupied building, the tenant has 12 months left on the lease, and then they're moving out. An investor says to you, hey, you should buy that property because look, the NOI is $100,000 a year. I'll sell it to you for $1 million. Okay, well, great. You buy it, you collect your $100,000 for the next 12 months, and then the tenant moves out, and now you're 100% vacant. Would you pay $1 million for that property in year 2? Probably not. So that's one piece of information that you want to watch out for when you're using the cap rate. Cap rate's really easy to misuse. As I said, when people are calculating the net operating income, sometimes they're running those numbers down and they're not actual to what's happening with the property. The other way you'll see cap rates misused is sometimes you'll see them used like a gross rent multiplier. Gene, I don't know if you've ever seen that, but I've actually seen brokers marketing investment property, and they've confused a gross rent multiplier, which is a multiple number, with the cap rate, which is a percentage number, and they get the two mixed up, and they go out and they're talking about a cap rate that isn't even correctly calculated.
No, definitely, and I think that's one of the biggest challenges we have is that we're not using the same language, or let's say they're defining it differently.
Mm-hmm.
Yep.
Yeah, it can be a real problem.
Yeah.
The cap rate also doesn't account for debt service. So what does that mean? Well, you remember that net operating income, we were calculating that based off of our operating expenses, but after we have our net income figure, we have to go pay the bank if we're borrowing any money. The cap rate's not accounting for that. And it's also not including taxes, so not in the sense of real estate taxes, because real estate taxes are part of your operating expense. It's the real estate taxes that you pay, or the income taxes that you pay on your income from the investment. So the cap rate's not telling you that part of the picture either. So what about this exit cap rate? Well, we all know that that $1 million investment that we're going to buy, if we're going to pay a 10% cap rate for it, we have to go and sell that at some point because we ideally would like to get our $1 million back and hopefully make a potential profit on the deal. So when we're doing that, we need to be conservative. Now, what we started out with our poll was saying, hey, 33% of everyone on this webinar thinks that cap rates might go up. So if cap rates go up, what does that mean for values? So if they go up, that could mean that values could go down a little bit. So that's something to keep in mind as you start to look at selling in the future. Where do you think the cap rate's going to be? And unfortunately, I can't tell you where it's going to be, but what I can say is that a lot of investors today, including myself, when underwriting a deal, what's happening is they're assuming that they're either selling at the cap rate they paid for the property. Okay, so if I paid a 10 cap, I think I can sell at a 10 cap, or they're pricing about a 50 basis point premium onto their cap rate. So they may say, hey, I'm buying it at 10, but I'm going to sell at a 10.5. And what that means is that I have to grow my net operating income in order to still make a profit, equity profit on the back end of the deal. So here's an example of growth. So we went from 100,000 to 120,000 a year in net operating income. And when we divide our $1.2 million value, we have a 10 cap. So what we did here was we increased the property performance by $20,000, and by doing that, when we sell it, we're adding another $200,000 in value to that property. And the reason that's working that way is because the next investor that's showing up to purchase this property is saying, I will pay you that 10%, okay? I'll pay you 10% of 1.2 million because I'm going to get my 120,000. So that $20,000 worth of additional work and effort and market rate growth that you put into that property, the market's rewarding you for that by paying you an extra $200,000 on the back end of the deal. This is where a ton of money is made in commercial real estate investing. A ton of money. Now one of the things when you go to calculate your exit is you want to make sure that you're using the forward 12 months of NOI. So what that means is if you're selling at the end of the 7th year, for example, in your holding period, you're going to use the year 8 net operating income to calculate the value. Because when you go to sell it, you are advertising or representing the next 12 months of income that investor is going to benefit from. So how about cash on cash return? There's a relationship that we've seen between cap rate and cash on cash return. And what that is that the cap rate really is just like a cash on cash return. It just means that we haven't put any leverage onto the investment. We've borrowed no money. We've paid all cash. We've paid $1 million, and we've gotten $100,000 back on our 10% cap. So that's the same thing as a cash on cash return. So what the cash on cash is it says, look, here's the percentage of your down payment that your investment pays to you in the first 12 months. Now, if I go and I purchase a property and I pay all cash, I'm getting my 10% cash on cash or a 10 cap rate. But what happens when I go and I start to actually leverage it and I borrow money from someone else and decide to put less of my own money down and to use bank financing in the deal? Well, what does that do to our calculations? Well, what we're going to do is take a look at that really quickly and see. That's where things get a little bit funny with these cap rates. So a couple pros and cons on the cash on cash. Similar to the cap rate, it's quick, it's fast, it's easy to use. It does account for debt service, so it is factoring in our net operating income less our debt service, so we know that we know where we're going to end up. And it also it does account for after tax. But the cons are that it's another 1-year snapshot. It does change annually. It doesn't account for appreciation. It doesn't account for amortization. which is that amount that we're paying down on the loan balance. So this is where that idea of the target cap rate comes in. And Jean, I know you've taught the band of investment theory before, right?
Yes.
Generally speaking, how would you describe the band of investment theory? I know I'm putting you on the spot, but
Oh, no problem. It's breaking up. It's actually calculating the cap rate based on the different investment objectives of the lender and the equity investor. And generally, the equity investor has more risk involved, so their investment requirement might be a little bit higher than the lender. That's how I define it.
Yeah, that's great. So basically what Jeannie's telling us is that most investors go out and borrow money. I mean, it's pretty common to go out, buy that $1 million property and put a down payment down on it and then borrow the rest of the money and pay an interest rate. So the issue then becomes, if you're just using the cap rate, you can get an idea of what you should be paying based on what you think your unleveraged return, cash on cash return should be. But if I'm borrowing money at an interest rate, then all of a sudden the cap rate formula gets a little funny, and I really want to understand how much cash on cash return I'll be getting. So what I'm going to show you, this I call it the target cap rate because it's a great way for you to identify the cap rate that's right for your specific objective. And the specific objective you had is defined by two things. Jeannie said the financing component, and that's the amount of money I'm borrowing to buy a property, and the equity component, that's the amount of money I'm putting down to buy a property. So I'm able to actually calculate the two pieces and add them together to come up with a target cap rate that I should be paying for property. And what these are comprised of they're comprised of the following. So I have my $1 million property, and now I'm going to go out and I'm going to borrow $800,000 from a bank, and that bank is going to lend me that money at 5.5% interest over 25 years. What you're looking to do is earn a 13.23% cash on cash return on that deal, okay? And you're going to put down $200,000 of your own capital. Now before, what we were generating when we paid all cash was 10% cash on cash. Now what I'm looking to do is to add more money I want to put more money in my pocket on a percentage basis. I don't want 10%. I want 13.23%. And what I'm doing is I'm going out and borrowing money at a lower interest rate than the 10%. So what you see happening here is if I can borrow money at a lower rate and I can put less down, then what I should be able to do is positively impact the performance of the investment and generate a higher cash on cash return. This is why investors use leverage in commercial real estate investing. It's all about getting a higher return, cash flow return, profit, whatever it may be, on their money by using less expensive capital than their own to invest in deals. So what you do, and I won't bury you in all the formulas here, is you develop a loan constant, which in this case, at a 5.5% interest rate over 25 years on $800,000 is 0.07369. So what that means is that for the money I borrow, I'm paying 7.369% of it back annually. And then I'm adding my equity constant, this is a weighted average number that's derived from this cash on cash return that I'm looking for and my $200,000 investment. I'm going to add those two together to come up with what my target cap would be. So what does it end up being in this case? What cap rate should I personally be paying for this deal if I'm putting 20% down, I'm borrowing 80% at 5.5% interest, and I want to earn a 13.23% cash on cash return? I add the two together and they stack up to the cap rate I should use, which is 0.54%. So what I've just shown you is a way to develop a highly personalized and targeted cap rate approach that gets you out of looking at guides. It gets you away from going out and having to look at what the last investor paid on a cap rate basis for a property, and actually building up your own cap rate to achieve a cash on cash target that you have or your client has, while simultaneously addressing the debt issue where they have to borrow money. And by running this type of analysis, you're able to come up with your own cap rate that you can then adequately value the investment with. So here's what we've done. We said we'd be on for 30 minutes. We're at the end here. We've talked about the essentials of net operating income. We define the cap rate in a couple different ways. We've given you the plain English version and the EC version. We've shown you the calculation, how it can be run in 3 different ways, as well as the exit cap rate. Talked about some of the sensitivities to figuring out what's going on, as well as what's happening out in the market today. And then we defined cash on cash and took you through a target cap rate example. So that being the case, Jeannie, I want to open it up. Any questions that people have, they're here to tap us. We're wired. Pick our brains. We're happy to take a few minutes and answer some questions for you.
Oh, I like the self-portrait, Jeremy.
Thank you.
I have a question while we're waiting for others. If folks have questions, you can put it right into the chat box. But do you have a resource for finding cap rates? I know you shared with us IRR.com, which is a good resource. Are there any others that you might recommend?
Besides IRR.com, you know, you can go out. So there are a couple of other resources that you can use. What's nice about REITs, which are real estate investment trusts, is they report and publish based on where they're transacting in the market. So you can use those, similar to those charts. So NC REIT. If you look up at REIT.com, you'll find some guides there. There are a lot of capital analytics reports out in the market. If you look up, I know Babson Capital has one that's got some nice information in it. A lot of the brokerage companies will publish cap rate charts. They'll take some of their own data, and then they'll compile data from other resources and blend it together, and then publish a report that says, hey, you know, here's what we see happening in the cap rate world. So if you get out and look around, you'll find some reports, and no one report is going to be the be-all, end-all. The thing to remember is that every investor is coming up with their own cap rate for what they think is a reasonable valuation for a property.
Okay. Now, we do have a question from Barbara Orlando. Is there a resource that instructs an investor regarding depreciation? One of the things that we do at New England Real Estate Academy, we do have live lecture classes on investment real estate that talks about depreciation. Keep in mind, I just want to make mention that they are talking about changing the depreciation schedules in the next coming year, so I think that that's an important thing to be looking at. Anything you want to add on where they can learn about depreciation?
Yeah, you know, Barbara, that's a great question. One of the best places to go, frankly, is to call a CPA. They're very current on depreciation, and as you know, there's the residential and commercial rates for depreciating property, but there's also there was a big sort of cost segregation became a very popular advantage to take for property owners over the past 7, 8, 9 years, and it's kind of run its course, and investors are using it quite a bit to speed up the depreciation time frame they have. That's now evolving even more, where the IRS is publishing unit of property definitions, where you're now going to be able to take portions of the property that you replace or repair and bring their useful life through and depreciate them against your income. So that there's a whole lot of information out there on that, and that's brand new stuff that's coming out. The preliminary regs are just now being reviewed and reported on. But if you go to a website like bedfordstrategies.com, they're a national cost segregation study provider. They should have some reports on there about what's going on out in the real estate world with depreciation and the latest news.
Okay. I don't see any other questions coming up, Jeremy, other than we were asked if it is being recorded. The webinar is being recorded, and I will have it available on our website at New England Real Estate Academy. And I also just wanted to mention that in other resources, Jeremy will give you a link. Oh, goodness, there you go.
Yeah, I've got, so a lot of the
Yeah.
information that is in this this webinar is available at creinvested.com.
Yeah.
We have a free report you can download. It's a PDF. You can grab that, share it, whatever you want to do with it is fine. And what it does is it walks through a lot of the content that you've just seen here, and it gives you it in a format you can read, reread, and we're happy to answer any questions you have. I know Casey just got in here under the wire, Jeannie. He asked, is there a place to learn more about calculating the two constants? Casey, there is. If you go out and you look up Band of Investment Theory online, there's a lot of information out there on that. It's a very popular calculation that appraisers use in their reports. They build up cap rates very frequently in their reports. So you'll find all the finance out behind that title online. You can read up on it.
Excellent. Excellent. And Bill, we can take one more. Bill, stop typing.
Okay.
Oh, thank you, Bill.
Thanks. We're happy to do it.
Yeah. And we will be sending out a Survey Monkey. It will just take you a minute to give us some feedback because, Jeremy, I want to thank you so very much, but we do want feedback. Did this work for you, and what other subjects would be of interest to you? Because Jeremy has agreed that we might be able to bring him back to expand on this subject or delve into something else. So I'm pretty excited to have had you here, Jeremy. Did you have any last thoughts? Oh, Tom just came in.
I'm answering him now. I'm typing it in. Band of Investment Theory.
Oh, okay.
Tom is what you can look up if
Okay.
you want to read up on that stuff. And what I do is when I teach it, I tend not to go too deep into the finance formula on that specific example. I've written I have a calculator that we've done in Excel, and we actually give that out to our students. But it just allows you to bypass all that, and we've already templated everything, so you can just run the calculation and see the output really quickly. Yeah, and Jeannie would agree with me. Having taught this stuff for a while, that it's really important to understand what's going on in the background when you're looking at this information. You're running your own calculations, because as you do more of it, you will start to see where the nuances are and to develop the insights that you need to have those killer instincts out in the market to make really good investment decisions. So really appreciate it. Jeannie, thank you for having us on. This is great. I thank you so much.
Jeremy, my pleasure, and thank you so much, and thank you to all of you who attended, and wishing you very happy holidays and a healthy, happy, and very prosperous new year to all of you.
Thank you.
Signing off.